Good morning, everyone, and welcome. My name is Johan Verboer, and one of the hats I wear is the one of Remarketing Program Lead for Nexus Communication. And I'm very pleased to moderate today's webinar, which is about cross-border dynamics and the residual values in this year in Europe. So this webinar is the first in a series of 3 sessions that will happen as from March up to end of April. So for today, I am delighted to be joined by 2 experts from JD Power, an organization globally recognized for its data-driven insights and deep market intelligence. So joining us today are Christian Schneider and Christof Engelskirchen. So the format today will be interactive. So we will begin with their insights and analysis, which will be followed by, if you have any questions, feel free, and I strongly encourage you to use this throughout the session. So welcome, Christof. So I don't think I've got a lot more to say, so I will give you the floor. At a very nice slide looking at, I think it's the first time I see the new logo on the slide, JD Power. So all yours.
Yeah, thank you, Johan, for the short introductions. And so my name is Christof Engelskirchen. I'm the chief economist of AutoVista Group, now JD Power. And I'm also responsible for our professional services, so everything related to analytics and advisory services in Europe. So before I ask Christian to introduce himself as well, I just wanted to break the news. And you're right, Johan, this is the first time we are presenting this brand and this slide in a webinar. So we have just undergone a rebranding of AutoVista Group into JD Power. And I mean, I think most people in our audience here know JD Power. JD Power is a very well-known brand worldwide. They do what AutoVista Group does in Europe, but they do more, and they do it in North America and China. So for us, from an AutoVista Group perspective, it has been and was a natural fit to combine. And now we're following up with all our branding. And if you want to find out more, scan the code. Don't worry, you'll not be dragged to some weird place or site. It's just our website, and you can see how the new logo fits in. And and also if you want, register for a couple of our upcoming webinars. And maybe Christian, do you want to say a couple of words about yourself?
Yeah, thank you, Christof, and thank you, Johan. So I'm Christian Schneider. I'm Director of Valuations for JD Power Europe. That means I'm basically responsible for all kinds of used car values that we are setting across Europe, but also forecast values. And I think this is also why I'm here today for the topic.
Great, thank you. So what we've done is we've had a discussion before, and we've taken out basically 6 elements we all are convinced that will be interesting for you to have their view on. So the first one is, what are currently the factors that are really impacting RVs today? So what do you think?
Yeah, so Johan, thank you for that question. And before we actually give you what we think about the residual values in 2026, we wanted to show you what, in our view, the most important factors and influences are for 2026. So if we look at the economy and a couple of macro level views on the economy, so real GDP forecasts and inflation forecasts, you could argue it's more of the same. Right, so we have that continuous level of depressed economic power, I want to say, in a couple of European markets. you have inflation, which has come down, but it's still not as low as some central banks would like it to be, which is a factor influencing us as well. So in a way, it's good news, yeah, because things are relatively stable, and we have been going through a couple of years of that, slightly depressed economic, dynamic, and have come out of it quite resiliently, or more resiliently than people may have thought initially. So that's the good news. On the other hand, of course, we need more momentum. We need more drive. If you look on the left side, you only see a couple of green arrows pointing up. One is for the US. That's not really our concern here today. And for Germany, that's great. So there is a big leap, a big jump up in terms of economic development, but only to a level of 1.1% in this forecast, which is, of course, if you compare it to the other markets, quite low. And if you look at the bottom on the left chart, so there is also there are economical challenges also in China, which means that they need to look elsewhere to make business, which they are doing. And it's also important input for us as an automotive industry to consider that there is pressure from China to look at markets outside of China to make business. And this is what we also see happening, and this is going to affect us. Another point, which is along the same lines, but this is now new vehicle or new passenger vehicle registration forecasts that we also publish. And you can see here that for this year, we expect only a very moderate increase of +1% in terms of registrations. Again, this is in a way good news for residual values. There is not going to be a particular supply pressure from this macro level perspective hitting us this year. So more of the same in terms of volumes. There's no way this year and also in the coming years that the vehicle volumes are going to be at the level that they used to be pre-pandemic. And the last point is a more technical one, but a very important one when we talk about residual values in 2026. So what you can see here is an example for two countries. Let's stay with Italy, for a second. So the line on the bottom, January 20, shows how a car's residual values were impacted by age. And you see a certain pattern, for this curve. In July 2023, where prices were up across the entire board of cars and ages, you could see how residual values were moving up. So the shape remained the same, but everything moved up. Now in November 2025, so last year, the curve has already had two changes. First, it dropped again to the levels that we saw pre-pandemic in this region here. But it also changed the form in this region here. So we are very much along, the lines of what we saw January 2020, so before the pandemic in Italy in terms of residual values, so back to normal. And if you think ahead, this line will start to come closer to this line in Italy over the coming years. So the outlook is what we believe is going to happen this year. In Germany, we are still a little bit above 2020 lines, but you can also see how the curve is normalizing. But we're still seeing slightly inflated. I'm using the term because it's technically slightly inflated values for 36 to 60 months old vehicles, whereas the younger vehicles have started to normalize. So this is a very technical but important input in terms of what we expect will happen with residuals.
Okay, now what does this mean? So these are the factors influencing it, and then I think it's important to get a view on what is then the RV outlook actually for this year?
So before we speak about the outlook, maybe just what we see on that picture as well is what residual values cross major European markets. I mean, how they have developed over the last 2 years, roughly. So since end of 2023, and we see that, I mean, without speaking about individual patterns, but that in general, all of them are decreasing. I mean, I think it's no big surprise for us. Christof also showed us before a little bit how the economic situation in the last years have been. So there has been a lot of pressure also from the economic side. We have still that very big increase after COVID that we are now starting to normalize again. So this is all of the reasons why we are going back a little bit to that. And what we also expect that this trend is going to continue for 2026 in most markets. So not as strong as in the years before. It is flattening a little bit out, but we expect for most markets a decline, I mean, across all across all segments and all propulsion types of roughly -1% down. So percent, not percentage points, just to be clear on that, to not make everyone panicking a lot. The only exception, I think, which is getting a little bit more extreme, or what we expect this year to be a little bit more extreme, is Italy. So we expect Italy to decrease by roughly 5%. But the reasons for that is that we expect that Italy is normalizing quicker than the others. So it's falling, let's say really falling a little bit more extreme this year, but then it is also flattening out way faster in the next years. This is our expectations, while the other countries are moving longer down, but a little bit more stable, I would say. So that is the difference between the markets. But of course, we also see different patterns across propulsion types. On the next slide, we see just exemplary 4 different countries, so Italy, Spain, France, and UK. It's very small, but I think we can see all of the patterns here. So it's more about the patterns here again than the individual numbers. So what we see is the index behavior of residual values since January 21 in a market split it by different propulsions. And the lower 2 graphs, 2 lines in all 4 charts are representing battery electric vehicles in red and plug-in hybrids in orange. And we can see that in all markets, battery electric vehicles, and in most markets also plug-in electric vehicles have been even harder affected by this decrease, mainly because of a lot of subsidies, especially governmental subsidies, but also sometimes from OEMs to reach targets, going into that, pushing those vehicles even more than the other propulsion types, generating a lot of pressure on the markets. Technology as well is aging way quicker, as we know, for battery electric vehicles, and all of this is leading into significantly lower or stronger decreases for those electrified vehicles than for the others at the moment.
Okay, thanks. What we've discussed about before, and I think it's very important for the assessment of the RVs, what's the impact, is an overview about what has changed in regulation and what potential impact will this have. Christof, I think this is your area more, no?
Yeah, I mean, we can both talk to the point, but I can take this one. Yeah, so there is most likely changing EU regulation because it hasn't been approved. Yeah, so it's a recommendation, or it's a proposal at the moment, which still needs to pass, the lawmaking bodies in the EU. But it's likely that these things are going to come into effect. So let me just summarize, the different changes. Yeah. So first line, 2035 tailpipe CO2 target was 100% reduction. This was the original rule. Yeah, and now the revised rule is that we are only targeting a 90% tailpipe reduction in CO2. but there is a requirement to offset these 10%. Yeah, second line. So low carbon steel in production, e-fuels, biofuels. So de facto, this is a reversal of the ICE ban. Yeah, if it comes into effect, and so that's a huge change. Then looking at line 4, small EV category, that is something that many of you, I'm sure, are aware of. There is likely going to be some special treatment. So the term used is super credits for smaller EVs produced in the EU. And what that means is there are going to be special incentives, special credits possibly given in terms of CO2 emission target achievement if you register more of these vehicles in the EU. And a little spoiler alert, the question a little bit for Christian is, of course, then, what is this going to do with residual values for electric vehicles if we see a push of these smaller EVs? Yeah. And then the last two lines are a little bit of a softening in terms of target achievement. Yeah. So for 2030, there was a target of 55% reduction. Now, again, the EU is proposing to flexibilize this arrangement. Yeah, so basically, you have now 3 years to achieve the 55% reduction on average. And I suppose the hope is that OEMs will somehow manage. Yeah, so basically, they're given 3 years to achieve it, but it has to be achieved on average in all years. And for LCVs, the target was reduced for 2030. So this is a flat out reduction because the EU is recognizing that it appears impossible to reach 50% for the industry. And so they are softening around that factor.
And I mean, so what does it mean at the end for residual values? Of course, we also prepared something around that. So I think on one hand, the obvious thing that all of us may think is, okay, the targets for BEVs, they are now softened a little bit. That hard deadline it's not intact anymore. So there will be potentially less pressure coming from a new car supply to the used car markets. But on the other hand, this whole wait and see behavior that we have now since quite some time in the EU, I would say. So sometimes we have stronger targets and we're weakening them again. Who knows what will happen in the next years again? That is putting a lot of confusion, I would say, into consumers' heads, so new and used. And this is also putting in quite some uncertainty into this behavior. So in general, that means for the majority of segments, for battery electric vehicles, we don't expect, because of this buyer hesitation, that the pressure on BEV residuals will get smaller because of that regulation. And in addition, because of that super credits for the small cars that potentially are coming into place, we also see a risk even of additional push here and oversupply of those small vehicles if OEMs then start to use that super credits basically intensively by pushing smaller vehicles into the markets. And I think so we see more a risk than a recovery because of it, I would say, in general.
Okay, we've been, I think the whole market is a lot talking about the potential that vehicles go to other countries. We see a flow going from more Western Central Europe, let's call it, to North, certainly if it goes about EVs. Do you have, the question here was, do you have some statistical really like analysis that would help understanding those flows?
So we looked in our data and tried to prepare a few examples or patterns for all of you to get a glimpse what is going on, I would say. And the first one that we would like to cover is this. So what you can see here, it's a lot of information, so I maybe spend a few seconds to explain it. So we see on one axis, so we see the residual value, and then on the other axis, we see the days to sell a certain vehicle. All of those dots or squares here are representing C SUVs, so the biggest segment that we have in Europe, I would say, and for individual countries. The dots, the orange dots, are representing the whole C SUV market, so the average of it, and the blue squares are representing pure battery electric vehicles. And what we can see already here is that all of the orange dots, they are way closer, I would say, clustered together in general, while we see way more differences for the battery electric vehicles. So maybe I would say, so if you have, let's say you have a car in Italy and you think about, oh, should I export it, or should I try to sell it within my country? There's not a lot of potential, I mean, with other countries with a higher residual value in general for C SUVs, if you only have that in mind. So there's a little bit of arbitrage possibility, maybe to a few of those circled countries, but they also take longer to sell. So you have additional costs because you have them longer in stock, maybe, to take that into account. But if you look on the pure battery electric vehicles and you have a car in Italy, there is a big potential, for example, at the moment for this C SUVs, to maybe move them to Germany, where you can achieve way higher residuals. So this is here something like 7,000 to 8,000 euros more on average, and you can even sell them quicker at the moment in Germany. So just as a first thing, so the fuel type definitely matters, and while we maybe see stable patterns for traditional propulsion types, I would say for BEVs there is more potential arbitrage possibilities to sell them maybe to another country, I would say. So that's one pattern. Another thing that is maybe interesting to look on is that cross-border potential could also differ quite a lot by brand. So we just use exemplary two brands here, and Opel and Volkswagen. And let's say if you have a used Opel in Austria on the left side. And what I should mention is this example is also for C-segment and petrol cars. So if you have a C-segment petrol car in Austria from Opel, you only see you only have limited arbitrage possibilities to sell them into other countries. So there is, to the highest in this case would be Spain, you have something like 1,800 euros, so not a massive arbitrage potential. But if you look in the same country constellation, same segment, same propulsion type, but a different brand on Volkswagen in this case, you could see that from Austria you have big potential to sell that, for example, to Spain or to France in this case, of around, I don't know, 5,000 to 6,000 euros, so significantly more than for a comparable Opel model. So the brand definitely also matters if you look on those differences. And a third pattern that we also looked into is that the age or also mileage of the car also could make a difference. So if we look on the left, we see what are the differences that we can observe at the moment, again, for a C-segment car petrol between Spain and France. And if you have a very young car, for 1 year, 10,000 kilometers, there is quite some potential, so 4,500 euros roughly, if you move it from Spain to France. Because, I mean, there are a lot, maybe not too surprising for us, there are a lot of rentals, of course, in Spain that we see, those quite young cars. There's a big supply in the market, so this is maybe why we see that big differences between those two neighbor countries. But if you look on an older car with significantly higher mileage, so 5 years, 150,000 kilometers, we see that both countries are performing on the same level, so there is not really any potential to achieve higher results if you would export it to France. So maybe better to sell some of the used cars to France, but not the older high mileage ones from Spain. And on the right, we see another example for those age mileage constellations. So if you own a used, again, C-segment petrol car in Germany, there is some potential to maybe sell it to the Netherlands, roughly 3,000 euros, but not a massive one, I would say. But if you look on a car with very high mileage, so 150,000 kilometers, we see that this gap between the countries is widening extremely. So we see roughly 9,000 euros difference here for this high age and high mileage cars, because they are really extremely undemanded in Germany at the moment. And those should maybe go more into export than the younger ones in that segment.
Okay, what we've discussed before is this is a snapshot now, basically. I think a question which is quite relevant is this, do you forecast this to be stable over time, or is there big volatility in how this changes? And almost maybe I can link the question to how can people follow this?
Yeah, no, thank you. That's a good one. So what we did here is on this analysis or this slide is we looked on differences between France and Germany. So how much higher residuals are in France than in Germany, basically, in the D-SUV premium sector, I would say. And if you look on diesel, so the yellow line or orange, we see that the behavior is really stable. So I mean, we have diesel D-SUV premium cars since decades. It's in the markets. It's established. We know where to sell them, how to move them. So it's a quite stable development, I would say, over time. But if we look on newer propulsions, so for example on plugins in this case, we see quite a strong decrease in this arbitrage potential over time between those two countries. So it is roughly 30% in this 2 years that we see here how this arbitrage possibility was decreasing. And we see now that the decrease in the beginning was a little bit stronger. Now it's flattening a little bit out. It's coming closer to a level like diesel, I would say. And we also would expect for this specific case that it will stabilize also around that level over the next few years. And that it is also getting more stable. And
maybe Christian, if you allow a comment also on this. So this is France versus Germany, and you may wonder why not more cars are then sold in France, right? Because if there's such a high margin to be made by selling these cars in France, so there is a theme especially also in Germany, that the brands, also captive leasing companies, they're trying to keep those cars. So the SUV premium, that's a prime beef, yeah, in terms of cars that you want to allegedly keep in your network to support your network, to support a lot of things. So you got to bear that in mind. So yeah, we're going to come to this in a second, but this is a stable gap which may be influenced by brands deciding to keep volume in the market and not exporting it.
Yeah, good one. And what we also did is, so that brand example that we saw a few minutes ago, so the difference between Spain and Australian residual values for 2 different brands in the C segment petrol cars, we see that the midterm pattern, so I put this in the dotted lines here, the averages basically, we see still a similar pattern over time. So in the mid-run, for Volkswagen, there are always bigger arbitrage possibilities than for Opel. So we can see that. So it's also stable, but what we can also see that it is quite volatile over months or quarters even. So depending how many cars are maybe sometimes in stock in a certain country and not. And so that could influence it, of course, month by month. But in the mid-run, we see a quite stable and consistent pattern, I would say, here as well for this brand behavior.
Just before we move over to the next question we foresaw, I just want to ask you to maybe give a comment on the question from Eva, who is talking about basically SUVs, PC. Is this also valid for other type of vehicles? Knowing where Eva come from, I'm sure it's about LCVs, not maybe HGVs, but LCVs below 3.5, above 3.5. Do you have any analysis there, or is the analysis possible? And do you think there's an opportunity there as well?
Yeah. So, I mean, let's start with if the analysis would be possible. The analysis would be possible also for LCVs. We haven't prepared it for that webinar, to be honest. But what we can say is, so we looked on the C SUVs, basically on that slide, I think, if I remember. And we can also see not exactly the same pattern, but similar patterns also for other segments. So passenger car segments. So that is not C SUV exclusive, I would say that. Yeah, so you see that.
And if I could add a comment as well, Johan. So we picked SUVs in some of the analysis because SUV is a body type that everybody across Europe loves in the same way, more or less. Yeah. Once we start to look at different body types, you might get a little bit different patterns. I mean, that's one comment. The second one, EV, as Christian showed in his slide, is a particularly interesting category, both EV, BEV and PHEV, because there are these huge discrepancies at the moment, in terms of volumes and prices and price realization. It's very dynamic, very elastic. So definitely, we're going to come to that in a second, but definitely if you're remarketing vehicles, you got to pay special attention on this EV category. There's also this, the second lease question mark for these vehicles more than for others, of course. But I mean, of course, cross-border remarketing becomes more and more important with tighter budgets, higher interest rates, and everybody trying to professionalize in that space. And seeing these gaps that Christian is showing is a little bit of I guess it would support having those discussions within leasing companies, captive leasing companies, big dealer groups on how to make more out of this, because these gaps could possibly become a little bit smaller.
Yeah, and I think that if we combine all of those elements, if we talk about eLCVs, there will surely be an opportunity as well, or certainly a space to be watched, to call it like this. Okay, that brings us to a recommendation ideas, which is, I think, is always very valuable. What's the conclusion, and what can X amount of people from the audience look at or do?
Yeah, so what we did is we try to separate or cluster a little bit the audience, or or recommendations by audience type. So we have on the top independent leasing companies and large dealer groups. Then we have captive leasing as a second category, and we have small, medium-sized dealers as a third category. So let's start with the independent leasing companies and the bigger dealer groups. So our recommendation would be, in light of the data that we showed, is that the decision-making frameworks for channel selection, which they are using, they are using, some are using it more professionally, others are still trying to really analyze the data and refine that decision-making framework, maybe to select the right channel. That is definitely a focus area in light of the data that we showed to invest in. Yeah. And our advice would be to really use the internal data that these companies have available for them and combine it with external data sources, for example, from us, in terms of what are benchmarks, what are trends, what are indices, how are things developing, to overlay the decision-making framework with that. Second category, we call it captive leasing. Of course, these are also huge companies with a lot of market share. And our hypothesis is that they probably should be working on adopting a more balanced approach between strategically supporting their own retail network with these premium used cars that they want to keep within their retail network. And I put in I mean, we know that there's a value in keeping these cars within the network, and that value probably should be quantified. We had a discussion with Johan a little bit earlier. He came up with this idea, and I like it a lot. So if you quantify the value that keeping a car in your network has for you in euro terms, right, in currency terms, then maybe that's a way to balance your decision-making approach, where cars should go, which ones you keep in closed auctions, which ones you keep in your own network, which ones you give to open auctions. Yeah, and that way you probably will be able to increase your profitability for your remarketing proceeds. And for small and medium-sized dealers, I think they are at the moment very capital constrained. So there the priorities are really on speed for remarketing, and their model will be probably a little bit simpler in terms of triaging which channel to use for cars. But I think speed is of the essence here, and probably less over analysis and probably more analysis of remarketing speed, how much it costs to keep these cars in stock, because that's binding capital, and that will be more important for these customer groups relatively to the others, although of course speed is important for everyone with interest rates that are significantly higher than 3-4 years ago.
Okay, any further comments from your side? I think you were planning to share people that connect to you or that use this QR code?
Yeah. No, so absolutely. So those people who have been registered or who are registering for this webinar will be contacted, and they can access the recording and the slides. Yeah, as far as I understood. Yeah.
Okay, if anyone has any final questions, I don't see it yet appearing. Any final comments from your side, Christof?
No, I mean, it's fine. If people have questions following this webinar, please don't hesitate to reach out to us. Yeah, and thank you for having us, Johan.
Yes.
Okay, no problem. So as we come to the close of this session, I think it was, we always try to do it within 30 to 45 minutes max. I would like to sincerely thank Christian and Christof for their expertise from JD Power, and I would like to thank all of you who joined today. As mentioned at the start, this webinar is the first in a series of 3. So before we close, I would like to also draw your attention to our next event, which is in 2 weeks on Tuesday, 10th of March, where we will host Trilogy Connect, focused on building your digital end-to-end workflow for remarketing. The link will be shared in the chat, but I'm sure that you will receive the communication from Nexus Communication Fleet Europe. So have a great day, and I look forward to continuing the conversation with all of you very soon. Thanks a lot.
Thank you.